What's up, family? It's Caden with Urban Finance. In this video, we'll be comparing two of arguably the best index fund. We'll be talking about the S&P 500 index fund as well as the NASDAQ 100. In comparing those index, we will look at Vanguard's S&P 500 index, VOO, and we'll look at Invesco's QQQ. If you're new to this channel, go ahead and smash the like button. That really helps out the channel. Feel free to subscribe to the page if you find something helpful in this video, and hit the bell to be notified of when I post something new. All right, let's jump in. So the S&P 500 and the NASDAQ 100 are examples of market index. And so this essentially means that they track a group of stocks. So the S&P 500 tracks about 500 large US companies across various indexes. It was created by Standard & Poor's in 1957, and it encompasses almost 80% of the total equity in the US stock market. The NASDAQ 100, the younger of these two indexes, which was created in 1985, tracks the largest 100 non-financial companies. So the NASDAQ 100 doesn't track any companies in the financial sector. So as you can see, the expense ratio for Vanguard's VOO is about 0.03%, and the expense ratio for QQQ, Invesco's QQQ that is 0.2%. And to give a real world example, if my math is correct, if you were to invest $1,000 over the course of the year into QQQ, that 0.2% expense ratio will be about $2 in comparison to the 0.03% for Vanguard. That $1,000 invested will cost you about 3 cents. That is how much the difference is in those expense ratios. And so those can't add up. But as you can see, that's not the only thing that we need to factor in here. So as we talked about previously, Vanguard's VOO makes up about the 500 largest companies on the US stock exchange, and Invesco's QQQ makes up the largest 100. As you can see here, it says 508 holdings for Vanguard's VOO and 103 holdings for Invesco's QQQ. Some of those are usually made up of cash accounts, and so there will always be some discrepancy from the 100 largest companies to the 500 largest companies for those ETFs or index funds respectively. Now, as we can see here, over the course of the last 10 years, Invesco's QQQ or the NASDAQ 100 has outperformed Vanguard's VOO or the S&P 500 index. And as we can see, over the course of 10 years, the QQQ has returned about 22%, and Vanguard's S&P 500 index has returned about 16%. Over the course of the last 5 years, QQQ has returned 27%, and Vanguard's S&P 500 a little over 17%. And these are significant differences. I'll actually give live examples at the end so you can see how much of a difference this is. But again, there are different factors at play here which will determine which one you actually want to invest in. And so it's not just about what has the lowest expense ratio or which one is returning the most profits. Here are the various sectors that these companies are invested in. So as we can see, the Vanguard S&P 500 is invested in technology, consumers, financials, healthcare, industries, consumer non-cyclical, energies, utilities, basic material, and telecommunication, as opposed to QQQ that does not have any investments in financials, as we can see, does not have any investments in the energy sector, does not have any investments in the basic material. So QQQ is very growth and technology focused, as opposed to Vanguard's S&P 500 that has a much wider variety of stocks. And this is one of the significant factors that will determine which ETF is actually best for your investment strategy. We see here the weight of the top 10 companies, and so the top 10 companies for Vanguard S&P 500 only makes up about 27.62% of the entire portfolio, as opposed to QQQ, where the top 10 companies make up over 50% of this 100 company portfolio. Now, which one of these two index funds is best for you? And it all really boils down to your risk management strategy. How much risk are you able to take on? Now, most people typically overestimate how much risk they're willing to take on or able to take on. For example, if you had QQQ during the dot-com bust, you would have lost about 80% of your value. And so many of us have not been investing since the 2000 bubble. Maybe you've been investing since the 2008 bubble. How did you react to that? Maybe you were investing when the market crashed 40% in 2020, and maybe you over leveraged growth companies in 2020 into 2021, and you're actually not making a profit even though the market is still actually killing when you invest in stocks like the S&P 500. How are you reacting to that? Now, if your reaction to those things have been cynical and negative to the great degree, then you're probably not someone that has a high risk tolerance. Someone with a high risk tolerance will most likely say, okay, the market is down right now, let me keep throwing my cash at it. Someone with a low risk tolerance will probably be panicking at the state of the market for more volatile stocks that do not have a good balance sheet. So for example, most estimates say that it took QQQ about until 2014, 14 years to recover from the 2000 dot-com bubble high. And if you adjust for inflation, it is said that it took it until 2017 to adjust for that high. So yes, QQQ is absolutely dominant right now. It is probably going to be more dominant within the next 10 years. If I'm a betting person, I will say that, but we don't know what the next 20 or the next 30 years may be. And so for someone like myself who appreciates a little less risk than that, then I definitely am heavily invested in Vanguard's S&P 500 index. So for me, based on my risk tolerance, Vanguard's S&P 500 is the better bet 100%. Now for QQQ, because it has been performing so well and because I believe over the course of the next 10 years, it will perform well, it wouldn't hurt to put a little bit of funds there as well. But believe me, 95% of my funds will be going to the S&P 500 index. And right now I do have some investments in funds that tracks the QQQ. So even on the risk side, I'm higher on the ARK side, which is a little more risky than QQQ with ARK-K, ARK-F, and ARK-G. But that is a small percentage of my wealth. I always say your goals should determine your investment strategies. And if you follow this channel, you know one of my main goals is financial freedom. And what gives me financial freedom in just about the same amount of time would be both Vanguard's S&P 500 or QQQ. And so for that reason, I will take the one with the lower amount of risk. So that's what I'm doing with my portfolio. For me, Vanguard S&P 500 index is still the better bet. Plus, I do believe QQQ is overvalued right now, and there are still stocks in Vanguard's S&P 500 index fund that did not recover, that may or may not recover, because we can never really predict what the stocks may do. But if it do recovers, I do think it gives the Vanguard's S&P 500 index fund a little more flexibility and stability, even if I was going into making that investment today. Now, if I did not invest in ARK funds as well, I would pick up QQQ. And so when I reach my cap for ARK funds, because I'm not going to be putting $300,000, $400,000 within ARK, I may put $10,000, $20,000. When I reach that cap, the next fund that I'll probably pick up is a QQQ, because I do like that exposure there. But I'm not going to put the bulk of my wealth in something that could potentially take 15 years to recover after a major crash. Now, with all of that being said, I do not think that QQQ will have a significant crash like that again, like we saw in the dot-com bubble, but none of us can predict the stock market over the short term. All right, family, I hope you found this video to be beneficial. Go ahead and smash that like button for me. And for those that would like to stick around to the very end of the video, I'll show a comparison of the 10-year returns for both of these index funds so you can get an example how your money would have actually been affected. And like I say, the difference between QQQ and the S&P 500 index fund in terms of the level of growth QQQ gave over the past was significant, and I do believe QQQ is the better short-term investment. And as someone that is primarily focused on the long term as myself, I do believe Vanguard's S&P 500 index or the S&P 500 index is the better long-term bet for someone with a very moderate level of risk tolerance. So I absolutely love this NerdWallet compound interest calculator. And so let's see, if we were to invest $1,000 every month over the course of the next 10 years, and QQQ got the rate of return that it did over the last 10 years, which is 22.76% and compounded annually. That will be $366,000 about. Now, if we were to say, let's look at the return that Vanguard's S&P 500 index fund would have give you, that would have been about a 16.61, that is. And that would have been about $268,000. So the difference of return for these two investments over the course of 10 years is actually about $100,000, considering that we're putting in $1,000 every month for 10 years. So like I mentioned, this is a significant difference. And so the only reason that I prefer QQQ is because we cannot predict what the stock market will do over the next 10 years, even though that I do believe that QQQ will outperform Vanguard's S&P 500 index or the S&P 500 index in general over the next 10 years. But who knows what would happen over the next 15 or 20 years. Now, with all of that said, if my goal was to have $350,000 to pay off my home in the next 10 years, then I would invest in QQQ because it would allow me to reach my goal. But if my goal was to have $260,000 to pay off my home in the next 10 years, then I will invest with Vanguard's S&P 500 because I can still meet my goal and I can meet it safer. And so that is how you have to play the stock market. What is your goal? How much years will it take it to meet your goal? And what is the safest way to get to that goal? And Vanguard's S&P 500 index funds for me is the safest way to get to my goal in the time period that I'm trying to get to it. Now, I hope you found that to be helpful and being able to set your goals for your investment strategies, because that's what it's all about. What are your goals? What are you trying to meet? And what type of investments will get you there in a time period that you have set out for yourself? Like I always say, God bless you, and remember to live your best life.